Good afternoon, ladies and gentlemen. Welcome to our special show, Market Masters. It's raining experts today, and it's our privilege to host Mr. Vetri Subramaniam, CIO at UTI Asset Management Company. This is his 8th year with the UTI, and since 1992, Mr. Vetri Subramaniam, a veteran of the markets, has spent time with other AMCs such as Kotak, Motilal Oswal, and of course Invesco. A very good afternoon to you, Vetri, and congratulations first. It's the 25th year of UTI Nifty 50 Index Fund. What a journey, right from the dot-com bubble to what is now a mild correction in the markets. What has been the learning?
Well, good afternoon, Shail, and good afternoon to everybody. You're right, this is a moment to celebrate and remember because, UTI has been the pioneer in investing in many senses, and this again was a pioneering effort to launch the UTI Nifty 50 Index Fund in the March of 2000. And you did point out effectively that this was effectively therefore launched somewhere around the peak of the dot-com market, which is very true. But the wonderful thing when we looked at the data, Shell, is that we have 2,700 investors who invested in that NFO in March 2000 and still remain invested as of date. That's both a number which makes us happy and sad. Happy that there are 2,700 and unhappy that there are not more than 2,700. So this has been, to my mind, a very simple and easy product, which is why we launched it way back then. I would say it was perhaps ahead of its time.
Yes.
But, in recent years, Shell, what we've increasingly seen is that index funds are becoming more and more popular with two cohorts. One is the younger cohort of investors who are coming particularly, through the digital route. And the other is with more sophisticated investors who are using this as part of their asset allocation process to achieve a certain objective. So obviously you've got pension funds, provident funds, and other institutional investors, but you've also got family offices who are using this for their beta exposure to India, because it is essentially a very simple investment solution which at any point of time is exposed to the top 50 companies in India, and it dynamically changes as the economy evolves. And you can see that in the journey of the Nifty 50 and its constituents over the last 25 years.
So, ladies and gentlemen, if you were fortunate to be in March 2000 with a disposable investable surplus of 10,000 rupees, so far you would have invested 30 lakh rupees, and they would have turned into 2 crore 7 lakh 58,177 rupees, which is an annualized return of 13.25%. If you haven't done it, you can do it today as well. It's so easy. So,
I always tell people that this is a wonderful advertisement, this track record of 25 years for systematic investment, because forget whether you came on the day we launched the NFO. Mutual funds are open-ended products. If you had just done a monthly SIP, your effective XIRR would be 13%. And that is a return in equities in a simple product which will allow you to achieve your financial goals. And that's why we think this is a very core product for most investors to consider.
And more importantly, if you had taken an equity diversified fund, of course US 64, as slightly older people in the market will realize, has been the pioneer out of the UTI stable to start the cult of equity in India. But ladies and gentlemen, please understand that it's a very simple product, equity. It's volatile, yes, returns come in short bursts, but they on average have outperformed every other asset class. With that background, Vetri, let's start our conversation about the markets as of now. You head UTI AMC, you manage about 1,31,000 crore rupees in investor funds, and they are invested over 406 stocks. This is the latest data, at least that I have. Now, tell us about sentiment on Dalal Street. We've had a 16% correction on the Nifty. The mid caps and small caps, many of them have collapsed. Because you've seen markets for at least 30, 33 years, how do you read them now?
Sure. I'll just correct one thing over there, Shailendra, which is UTI Asset Management manages almost three
Yes.
and a half lakh crores, and
Okay.
between our active and passive equity, we manage almost 2,70,000 crores. So, it's a very large equity portfolio that we
Yeah.
manage. And offshore, we manage another, close to 25 to 30,000 crores of
Okay.
offshore money, which is also invested in Indian equities.
Hmm.
So that is what we do. Now, you talked a little bit about, the markets and the recent volatility.
Hmm.
And, I just want to put this in context, Shailendra, because I think we focus too much on short-term volatility. There is certainly risk associated with investing in equity, which comes from short-term volatility.
Hmm.
But I would submit to you that the greatest risk that will prevent investors from achieving their in long-term financial goals is the absence of investment in equity. And in fact, one of the best examples of that, because we are having this conversation today, is the Nifty Index Fund, which we launched 25 years ago. It started in March 2000. In its first, 1.5 years, it dropped by almost 40%.
Yes.
And yet, 25 years later, a simple investment strategy has delivered CAGR of 13% through the SIP route.
Hmm.
So that is the best reason for why you should remain invested in equity and not worry about short-term volatility. Short-term volatility is part and parcel of the journey when it comes to investing in equity markets.
Wonderful. So we take that in our step. We use this volatility to get back into the markets if we are not already there, and if we are already there, we use this dip to buy superb quality funds such as the ones that are going to be discussed. Now, Vetri, I just needed to get this clarified. I was going through the entire portfolio of UTI AMC. I'll just check this data with you. Is cash still about 11% of total equity assets?
No, no, that's completely incorrect.
Okay.
Not sure where that number is coming from, but let me just put it in perspective. So, first of all, UTI AMC is not the right way to think about this. The schemes of UTI AMC, because we run this on a fiduciary basis for underlying investors. So, the accountability is not at UTI AMC level, it's the accountability to individual investors who have put money in those schemes. So, I would never aggregate to understand what we are doing. Point
Okay.
number two, we actually don't have 11% cash. Only reason, if at all you're seeing 11% cash, is maybe the number includes our hybrid schemes. And the hybrid schemes might have, short-term fixed income instruments, and there could be cash in the balanced advantage portfolios. But if I look at the simple, what we call the equity schemes, we do not take asset allocation calls in our equity schemes. Our traditional equity schemes will not have more than 3% cash on average, not just today, but if you go back in the last 5 years, at any point of time, you will not find, 3% will be the average number of cash if I were to average it out over that period. We don't believe in taking cash positions in our equity funds. Where we do take, a call on asset allocation is on the hybrid set of funds, particularly the multi-asset and the balanced advantage fund, and to some extent in the equity savings fund. In these funds, we have an internal model. That internal asset allocation model tells us how much to allocate towards equity, and our allocation to equity is a function of that. The rest remaining money would go into fixed income, short dated instruments in many cases, and there could also be some cash over there based on the attractiveness of yield. But otherwise, you will not find cash in our schemes. But to your point, Shell, I will give you this much, which will give your investors perhaps the insight you were trying to drive me towards. In our dynamic asset allocation funds, the BAF and the MAF, our equity allocations were closer to 52 to 55%, even if I go back 6 weeks, right? As of today, those allocations have climbed to 62, 63%. Because into the fall, the valuation model started telling us that now valuations are attractive. So now you can start increasing your equity allocation. But at which level to increase and how much to increase is driven by the model. This is not a subjective decision by the fund managers. So I would just say equity valuations are in, sort of the fair value zone, which is why the model is telling us to raise equity allocation. But when I say equity valuation, my models are driven by Nifty 50. So I'm only talking about the large cap space over here.
Yes, and that was my next question. You've been shopping very, very heavily, Vetri. I will not name stocks because that would be slightly problematic for you. But across the board in the Nifty 50, UTI AMC is out with a shopping bag and increasing its stake in, let's just say, four-wheeler giants, the top software companies, NBFC space, telecom you like a lot, banking of course you have a very strong background in banking over the last 30-34 years. You've been shopping there as well. Tell us, is your valuation model now goading you to deploy money into large caps, and if yes, what's the genesis and the logic?
Sure. Maybe first I'll just do yes, no, so that it gives a simplistic perspective. Large caps are in the fair value zone. Yes. Are large caps cheap? Answer is no. Mid caps, where are they? They are still in the very expensive zone. Small caps, where are they? They are still in the expensive zone. From our point of view, therefore, the area of market where we have comfort is really only in the large cap space. Mid and small cap space, yes, some stocks have sold off a lot. We do see some discrete bottom up opportunities. But, if you were to call me up and say, should I invest in a mid cap fund or a small cap fund, I would simply say, no, my preference at this point of time is stick with a large cap fund, not with a mid cap or a small cap fund, because the aggregate valuations are still not very comfortable. In terms of sectors, which sector do we think the biggest opportunity is at the current juncture in terms of the best combination of valuations and growth? We actually think it is in the banking and financial services space. None of the other sectors, to our mind, has a particularly strong call out at this point of time. Finally, one word of caution, Shailendra. We run discrete mutual fund schemes. Each of these has a very distinct positioning and philosophy which runs the scheme. So you could find one scheme which is overweight in a particular sector and another scheme which is underweight in the same sector, because their investment philosophy is very, very different. So, I don't want to give people a broad call out to say this is UTI AMC's view at a sectoral level. I always say it's relevant to a particular fund. But as CIO, the only two thematic funds or sector funds we are currently recommending. One is banking and finance, where we think absolute valuations are cheap and it's a good idea to invest lump sum. The other one, which we think is an attractive investment but more medium to long term on a staggered basis, is the innovation fund that we run.
Okay. So, BFSI fund and innovation is what you are basically trying to get investors to latch on to. Okay.
And if investors have lump sum that they want to allocate, our preference, even in today's environment, would be with the dynamic asset allocation funds, which I
Yeah.
basically referring to the BAF and the multi-asset, because here we believe we are actually getting a attractive positive carry on fixed income, reasonable equity allocation, but not fully in there as yet because the valuations have not gone to cheap territory.
Fair point. Now, Vetri, this move towards PSUs, what we are seeing over the last 2 days is some sharp bounce backs. It could be bear market rallies, it could be dead cat bounces, only time will tell. But in the valuation universe that you keep looking at in the large cap PSU space, are, I, are there any attractive stocks that have come up? It could be sectors as well.
Um, yeah, good question, Shailendra. But I would once again tell you that look, I think defining a theme as the owner of that business is the wrong way to think about it.
Okay.
I do not encourage people to buy businesses on the basis that they belong to the government of India. Neither, for that matter, do I encourage people to buy businesses because they belong either to the Ambani group or the Birla group or the Tata group. That is not the right way to think about investing. What you want to focus on is the fundamentals of the business and am I getting it at a good price, right? That has nothing to do with the ownership template. There could be poor businesses in great ownership groups, and the vice versa as well. So that is not the way I would look at it. Secondly, I think 1 to day trends are too short term. That is not what we focus on. If I look at my entire family of equity funds, most of the active funds have portfolio turnover ratios which start at 10% and go up to 50%. At a 10 to 15% portfolio turnover ratio, I'm churning the portfolio once every 5 years or 6 years actually. So, we don't churn the portfolios for daily moves. Our most aggressive normal active funds have portfolio turnover ratios of 50, 55%, which still means at best the portfolio turns once every 2 years. So, daily moves are not something that particularly excites us. And again, the ownership perspective is not what I would like to look at. Within individual sectors, we are seeing some opportunities for stock picking, but I don't like to discuss individual stocks, so I'll leave it at that.
Okay, fair point. Uh, Vetri, what are the spaces that you are avoiding given the moves that we've seen in terms of valuations coming down?
Sure. I think that's a very good question, Shell. One of the areas which I've had concerns about in terms of valuation very early to the game was the entire industrial space. That has sold off now, quite a bit into this recent correction, but the valuations still, to our mind, look more expensive than we would be comfortable with. So the industrial space is not something that particularly excites me. And I also think recent developments, particularly on trade policy emanating out of the US, actually would cause entrepreneurs across the world to halt all investments in manufacturing tradable goods, because you are really in such an uncertain environment regarding how will you integrate with global supply chains, or how will global supply chains flow through, and where what impact there could be on your end markets. So I'm still very, very cautious on that industrial segment, so to speak. If there was a dark horse which I would sort of look at today and say, what could happen over there? I would say that is really the metal space. This is a very cheap area. Unlike in the past, these companies today have much better balance sheets than I've seen of metal companies in the last, 20 years in India, when typically they've had far more fragile balance sheets. And I think over here, the scope for good news to sort of cause them to do well is quite high. But it's really more of a dark horse candidate, as compared to, banking and finance, which I would put as in that attractive category already.
Okay, so this is related to the kind of large balance sheets that we are seeing now emanating out of India in the metal space. Fair point. Uh, Vetri, what about this move towards cheaper loans, as also the interest rate cycle which was supposed to tick fairly aggressively in 2025, but the rupee depreciation seems to have paused it a bit. What would be your view on interest rates over the next 8 to 12 months? Do we see easing of loans, and more importantly, do we actually see an interest rate cut?
Let me just change that question around a little bit, or I'll just answer it very differently.
Hmm.
I think what we have to keep in mind is that the scope for RBI to cut rates is frankly limited.
Hmm.
Even for the previous policy cut, our view was 2 to 3 cuts. And given what is happening in other parts of the world, the only reason you would see dramatic rate cuts is because, let's say, the global economy goes into free fall. And that is not a good scenario for you to be seeing rate cuts. You would have to worry about growth in that scenario rather than look at the upside from rates coming down. And I think in the Indian context, right, we have to keep this in mind. Remember that we have been in a slowdown in terms of credit growth, which actually goes back to the fourth quarter of 2023, when RBI, in retrospect, rightly so, started to clamp down on what they saw as very aggressive lending practices in the consumer space. But I think that slowdown has now played out quite well. Credit growth in the economy has slowed to about 11.5%, just a shade above nominal GDP growth. And I think as Indian policymakers come to look at how do we get growth to increase, because the last two GDP prints were obviously not very, nothing to feel
Hopeful.
very good about. I think you will start to come to the point where policymakers are starting to say we are now a lot more comfortable with the financial situation, and we are comfortable with credit starting to expand again, but
Yes.
certainly not in those unsecured, consumer loan spaces. So I would say don't worry so much about how much the rates can come down.
Hmm.
Once you have system liquidity in place, once the
Yes.
RBI commits itself to creating banking sector liquidity, credit growth can accelerate comfortably to 300 to 400 basis points ahead of nominal GDP growth, and that is a reasonably attractive space for financials.
And that perhaps is the reason why UTI AMC has been shopping very aggressively in the NBFC space, and of course the private banking space that you mentioned. Vetri,
Absolutely.
yes. Vetri, when we look at the overall GDP data, uh, are there any hits and misses that markets have failed to anticipate, especially the auto space? You saw data that has just come up recently where, uh, you know, I can't remember a time when auto sales were negative in India on a year on year basis, but somehow that's happened. Is that a problem with the underlying economy where, you know, we have reports that people don't have money to spend, or is it just that companies are not coming up with great models? Where do you think the truth lies?
Well, it can never lie on only one dimension because,
Hmm.
when you talk about the economy, it's always multidimensional. So all of these factors come into play. But I would say don't discount the fact that effectively you have slowed credit growth very significantly.
Hmm.
Uh, Over the last, almost 2 years now. And that slowdown in credit growth obviously affects demand. So that impacts some of the things that you're talking about. I think the other context which is very important to realize, Shailendra, because I think this has really changed and it's particularly visible post COVID, is that India's focus at some level appears to be that at the first level, what we want to do is we want to maintain macro stability and we want to be in a macro prudential trajectory. Right, that is visible in the way we have managed the fiscal deficit and the monetary
Ah.
policy, both of which are extremely conservative. Correct. In a sense, when you do this and when you emphasize macroprudential stability, growth actually becomes the residual outcome. And growth has suffered as a result of this
Hmm.
focus on macroprudential stability. But it's very hard for me to argue that being fiscally prudent or monetarily prudent is a bad thing. I think it's a good thing.
Yes.
But fortunately, we are now in a place where we can start to pull take our foot off the brake to some extent, give a
Hmm.
little bit more fuel to the engine of the economy in terms of fuel and get things starting to move ahead a little bit. Now, the big point to remember here is that for the last 2 years, nominal GDP growth is running at 10%. So,
Hmm.
my only caveat would be that if we are increasingly in an environment where nominal GDP is only 10 to 11% growth, inflation targeting remains in place 4% plus or minus 2%, then the era of thinking about 12%, 14% nominal GDP growth and 15% profit growth may well be behind us. There will be cyclical periods, but the longer term outcomes will need to align with the reality of a 10 to 11% nominal GDP growth. And I think that's a reset which perhaps equity market participants have not fully factored in as yet.
Yes, that is to do with the expectations which need to be trimmed drastically, ladies and gentlemen. Yes, equities give you bunched up returns, but we do need to trim them, especially given the last 4 years that have lapsed. Thank you, Vetri, for this wonderful, wonderful conversation. I'd just like to mention a nugget of information. In March of 2000, when UTI launched the Nifty index fund, the Nifty itself was 1,204. We are now, ladies and gentlemen, at 22,500. So the index itself has gone up so dramatically, and
Well,
that is itself a wonderful example of how 2,700 investors have ridden this rally with very little risk and with great comfort and great wealth creation. With that, Vetri, thank you so much. May the next 25 be better than the previous 25.
thank you so much, Shalendra. Delight to have this conversation with you today.
Okay. As always, a pleasure at our end as well, Vetri. We hope to get you back fairly soon. That, ladies and gentlemen, was Mr. Vetri Subramaniam, CIO, UTI Asset Management, and he's hopeful on the banking financial services space. He believes the metal space could be a dark horse. He's completely avoiding the industrial space and those stocks which are linked to the trade policy of the US. Apart from that, at the moment, he is recommending UTI investors to take a look at the BFSI fund at UTI and of course, the dynamic allocation and BAF funds. Thank you for watching. I hope this was an interesting conversation for you as it was for me. Have a nice day and a lovely evening. Good afternoon, ladies and gentlemen. Welcome back on Business Today Television with our special episode on Market Gurus.